Hello, everyone. Welcome back. So for our next panel, we're going to talk about how Dodd-Frank is holding up in this current crisis and whether it's prepared us for the next one. Some of the criticism of the law has centered on the idea that Congress was fighting the last war, addressing the problems that caused the 2008 crisis, but not necessarily in a way that would be useful for future crises. And I'm interested in digging into how Dodd-Frank regulations are and aren't built for the future. As a reminder for those of you just tuning in, viewers can submit questions for speakers by emailing events@brookings.edu or by joining the conversation on Twitter using hashtag Dodd-Frank10. I'm joined by Austin Goolsbee, a professor at the University of Chicago and a former chairman of the Council of Economic Advisors under President Obama. Aaron Klein, a Brookings fellow who you'll recognize from earlier in the event. He served at the Treasury Department under Obama and before that worked as chief economist at the Senate Banking Committee. We also have Meg Tyre, a partner at the law firm Davis Polk and an adjunct lecturer at Harvard Law School, as well as Charles Yee, who is a partner at Arnold and Porter, a former FDIC general counsel and a former congressional staffer. So one of the prominent aspects of the government response to this crisis is the Fed's extensive actions under its emergency 13.3 authority, which was sort of curtailed under Dodd-Frank, but not too much. So I want to start with a broader question to you, Austin. Did Dodd-Frank give the Fed too much power, or did it strike a good balance? And how might Congress think about that going forward?
Oh, I thought you were going to say, did they give him too much power, or did it take away too much power? And then I was going to say, or did it do both? Look, I think it struck a good balance. The thing that we're seeing with this COVID crisis and the COVID recession is very different from a typical business cycle. And thus far, there's not really what I would call a systemic financial crisis associated with COVID. There could become one, but it hasn't happened yet. So in a way, this moment is not exactly a test of the premise of your question. That said, the whole discussion and battle over, are we restricting what the Fed is allowed to do in a crisis, or are we enhancing what the Fed is allowed to do in a crisis, which was one of the central themes of argument, if you want to think of it, in Dodd-Frank. I think the events of now kind of illustrate how hard it is to change things just by writing them down, even if you write them down specifically in the law. So if you take resolution authority and the argument of should the Fed be allowed to do bailouts, or can it have hospital expenses or only funeral expenses? And we kind of wrote down, no, only funeral expenses. You can't use that for any medical bills of living institutions. And the fact that the CARES Act comes up with trillions of dollars and it says we're going to turn over $5 trillion of Fed lending to big businesses kind of is in the spirit of saying maybe the tough guy authority, a tough guy version of resolution authority is unrealistic, even if that's what's written down on a piece of paper. If Congress decides they're just going to pass and hand it over to the Fed, they're just going to hand it over to the Fed.
Yeah, and Aaron, I want to bring you in on this. Obviously the Fed is doing a lot of things, bond buying. It's supposed to be lending to Main Street businesses. We'll see how that goes. Do you think that poses a risk to the Fed? Do you think that that's, in line with what Congress was kind of envisioning for 13.3 when the Dodd-Frank changes were made?
So Congress has been in a great fight against Congress, and it has been losing constantly while it's been winning. And to make sense of that gobbledygook, you have to appreciate what Congress did here. First, they restricted the Fed's authority specifically for domestic money market mutual funds, using a very specific tool called the Exchange Stabilization Fund from the Treasury Department in the legislation that created TARP. What was the first thing this Treasury Department did in this crisis? Use that very same fund to bail out the very same set of mutual funds, holding aside the law or the Fed. What did Congress come back and do? After the 13.3 crisis and the bailouts of 2008, Congress tried to tame in the Fed a little bit. What did it do in this crisis? It turned around to the Fed and said, please save us. please bail out society because the Fed is suffering from the curse of competence. What they did in 2008 broadly worked for the wealthy and eventually worked for many more people. By turning to the same playbook here in the CARES Act, Congress has made a giant mistake. Let me be very clear. The Federal Reserve buying debt of Apple, eBay, Equifax, and Google does nothing to help Main Street or working Americans. It's great if you own stock or debt in Apple and eBay and Equifax and Google. That's what this current bond buying spree the Fed has gone, and helps explain why Apple stock is at record highs while the US is suffering potentially a second wave of the pandemic and shutdowns are growing. And so, Victoria, the question is a little bit more complicated because Congress is being deeply inconsistent. When it is politically popular to have a backlash against the Fed, it is taking a backlash. When there's a crisis, it's running to the Fed to try and save things. And everybody uses the term Main Street. And I can't figure out if Main Street is the Apple Store and Potbellies and Shake Shack, because that's who's getting the money, or if it's supposed to be small businesses and workers, because they're the ones being left behind.
So, Victoria, let me disrupt your careful sequence here and make a couple of points. I know you intentionally didn't tell us what the questions are going to be beforehand, so we can be spontaneous. So let me try to be spontaneous. Two things. One, I have a slightly different analogy about the resolution authority than what Austin used. The way I think about what Dodd-Frank did is if you burn your own house down, your neighbors are not going to chip in for you to rebuild the house. You got to move. That's the way I view the Dodd-Frank resolution authority. As far as what Dodd-Frank did to 13.3, I think one change that was made, whether you agree with it or not, I think it actually has a healthy impact on the Fed, which is that Dodd-Frank prohibited the Fed from bailing out any one individual company. And whether you agree with that policy or not, my fear during the last crisis was that over time, if the Fed is seen as continuing to bail out individual companies, so people burn their house down and then the Fed is paying to have them rebuild it. I thought the political backlash over time would be too great for the Fed to withstand and possibly threaten its independence. So I thought that would not be healthy in the long run.
You know, there's one thing we're skipping over that's really important, which is one of the breaks on 13.3 authority that Dodd-Frank put in place is that the Treasury Secretary has to concur. And what's happened in light of this horrible pandemic is that it was very easy to get the Treasury Secretary's concurrence. But if you think about it in terms of accountability and responsibility, there could be situations, and we worried about this at the time of Dodd-Frank, would a Treasury Secretary be unwilling to use the political capital to unleash the 13.3 powers? So that, I think, in a future crisis could well be a break, and it's probably an important break. It's just that here everybody is together on the need for something to happen.
And I think that's right. And I kind of think the combination of Meg's point and Charles' point, it might be my inner conspiracy theorist, but I kind of think they did this on purpose, that we're handing all this authority to the Fed, we, the Congress and the nation,
right,
precisely so that if it goes wrong, they can say, oh, the stupid Fed messed the whole thing up. And if only the Fed, we had nothing to do with it. And that, I think, is a really scary spot for the Fed to be in for its future authority. Hopefully everything will go fine. There won't be a crisis.
Right.
If there is.
No, I completely agree with that, because the Main Street program, when putting aside Aaron's points at the moment on the bond buying, which is a financial crisis tool, but the Main Street program is something new and different. And who and what those companies are going to be, whether that program is successful or not. And it's all going to be transparent, right? We're going to get names of lenders, we're going to get names of borrowers, we're going to know, the core terms of the loans. So there's going to be transparency there. And if it doesn't work, you're right, it's set up so the Fed takes the heat, not Congress. Look what's happened in PPP, right? That's a program, kind of the Treasury and the SBA were having to build the plane while it was flying. And there were a lot of glitches in that. but it's not Congress who's taking the heat, it's the Treasury and the SBA. So
Just following up on.
Hold on a second there,
All
because
right, I'm after Aaron.
a couple of things there. Number one, Congress is taking some heat, and deservedly so, on the PPP for giving money to the Lakers and other big small
Go
business.
Lakers.
The got the LA
I'm from
guy.
LA.
Number two, I think there is no crisis for Apple's debt. There was a momentary drop in their stock price, boo-hoo, right? But thanks to the Fed, it's now flying high, right? Same with the rest of the NASDAQ. That's what the Fed's buying, 1% Apple. Two, in terms of Austin, I think it's less conspiracy and more a combination of two things. Number one, the curse of competence. Kate Judge and I are working on this paper from the Fed was so good in responding to the financial crisis of '08 that Congress ran to it to deal with an actual viral economic crisis. I agree with Austin. The root causes of this crisis are totally different. Why 13.3 lending authority should be the solution is not, to me, a conspiracy theory of Congress trying to find a new blame guy, but the inability of Congress to do its job under Article 1, which is to pick who gets money. Does it go to workers or does it go to bondholders? What kind of workers? How much? And instead, funnel this through the financialization of the economy, the Fed and the banks, and say, here, you guys figured this out. And I think that's problematic, both inefficient in terms of responding to the real problem and not good for the long run stability and purpose and role of our financial and our central bank.
So to Aaron's point, he and I both worked in Congress, and we like to think that we were devious. I don't think we were ever that devious. So that's point one. Point two is following up on Meg's point about 13.3. Now the Fed needs Treasury approval. I'm actually not sure which way that breaks, because Treasury is a political creature, right? And if a politician, if the neighborhood is burning down, right, the optimal solution is you get to build your house back and live in it again, but your neighbors don't pick up the tab. So somebody else pays for it, namely the Fed. So I think the Treasury actually may be a motivator to push the Fed into doing more as opposed to doing less.
Well, that's what we've seen in this crisis. What it will be like in the next crisis, we don't know, but that's how it's played out in this crisis. I mean, I want to get back to what you were saying about resolution authority, Charles, because it hasn't ever been used, right? And either the bankruptcy variant or the orderly liquidation variant. And I certainly hope we're not going to have to use it as this credit cycle plays its way out. And so it looked, will we ever have proof of concept? That is very unclear on resolution authority. But on the other hand, given all the work that's been done over the last 10 years on the creation of living wills and, all of the kind of making sure that the channels of funding run in the companies, the best we can hope for there is what I'll call an announcement effect or a demonstration effect. The framework's there, and we'll be better off if we never have to use it. But at least we've put in place structures. We just don't have proof of concept.
So I hope we do use it. If we never use it, that means that we've ensconced too big to fail, because somebody's got to fail. If a single large bank never fails in the history of the rest of this country, then we have a deep problem. Let people who make financial investments lose money.
So
the other parts of Dodd-Frank work, so a big bank could fail, but it's not systemic when it fails. I'm hoping that's the case.
Right, not systemic when it's failed. Well, that's the largest bank to fail since the financial crisis wasn't that large, right? That was Doral Bank in Puerto Rico. And that started out at 10 billion in assets. And with the use of, timing, which I think the FDIC very effectively used, it was 3.9 when it did fail. And then they managed a purchase and assumption agreement. That's that's not a big bank.
Job, by the way.
Pardon me?
That was my first month on the job. I still live in that.
Yeah.
That's not a big bank, but I'm just saying there's.
And that was hard, by the way.
It was hard. It was hard because.
Failure isn't easy, but no failure is worse.
The thing is, I still can't get past this. It's sobering as you look back at Dodd-Frank. I think there's a lot of important conceptual and detail work that was put into Dodd-Frank. and we were rightfully proud of it. But this juxtaposition that in some ways it doesn't matter what's written down in the law if the administration or Congress or whatever is just going to ignore it. And I said the resolution authority thing. Aaron had the better analysis, which is things that were specifically forbidden, like with the money market mutual funds, that they just did it anyway because it's a crisis. That, if you think about the Consumer Protection Agency, where they wrote down, here's what the agency is to do, but if you appoint a head of that agency that just says, no, we're not going to do it, we're saying there's not much you can do. So it's good. It's still an achievement to write it down and to get that conceptual framework out there. But the devil is always in the enforcement of those things.
Well, what you need is consensus and buy-in. I mean, having been on both sides, having actually written law in Congress, and then being on the other side of Treasury and FDIC implementing the same law, sort of your own cooking, which is not a good thing in my case. But I have seen the limits of congressional power. You can write whatever words you want on a piece of paper, but if you don't have buy-in from the people in the executive branch who have to implement the law, OFR is a good example. It's just not going to work. And I'll just give you a very small example of that is, now I laugh every time I see in a statute that says Congress is mandating that agency so-and-so promulgate rules to implement this provision within days of enactment. Never happens. That law gets violated every time it's enacted.
Right, and it's unenforceable, right? We're still waiting for some of the Dodd-Frank things. Let's go back to, sorry, Aaron, can I get a word in edgewise here? Thank you. The money market funds, right? Now we've got two instances and two separate crises caused by two different economics that the framework for money market funds is not working. And what was done after Dodd-Frank is not working. So that, in my mind, that needs, unlike other things in the Dodd-Frank framework, which are working pretty well, that's one that really needs a rethink. And,
so I want to, sorry, Meg, I just wanted to jump in here. I didn't want to interrupt you guys because you had a good flow going there. But I also did want to ask, because we were talking about, resolution planning and all of that. One of the things that's always kind of fascinated me since Dodd-Frank is the fact that for liquidity rules, nobody really knew how they were going to actually work when the chips were down. And so I'm curious, I'll go to you, Meg, for this. I'm curious what you think about, what this crisis has taught us about how liquidity rules work and how maybe they should be tweaked going forward for the next crisis.
Well, let me say about the liquidity rules, and I think of them and the leverage ratio is in kind of the same breath. And what we learned in this crisis is that there's a flight to quality in deposits, right? So we've seen incredible deposit inflows into the banking system. At the same time, we've seen outflows from money market funds, but we've also seen deposit inflows coming from, and this goes to the too big to fail point, I think from smaller banks into bigger banks. And so that is why there's had to have been some tweaks into the leverage ratio, because it was about to become binding for some banks so they couldn't in fact do lending. Charles and Aaron and Austin probably know these better than I do, but I think that on the liquidity rules for banks, which are about HQLA, is about what to do if there's outflow from the banks. We've had the opposite problem this time. We've had inflow. But Aaron, over to you. I see you're nodding.
I was going to agree with something that you said, Meg, about how the rules are unenforceable, as Charles pointed out, about an agency shall promulgate. In fact, I believe one of the ways that we could have avoided the financial crisis was if the Federal Reserve had followed the law under the Home Ownership and Equity Protection Act of 1994, which required the Fed to promulgate rules on subprime mortgages. Congress required it in 1994. Greenspan said, yeah, not going to do that. Don't believe in it. Turned down Fed Governor Ned Gramlich on that. And the Fed didn't do anything until 2007 when, the cat was way out of the barn. Congress had no authority to do anything to the Fed, right? There's no appropriations. The Fed has all this independence. When the Fed ignores Congress, and it wasn't a may, it was a shall. So one of the proposals, I studied Dodd-Frank in a prior incarnation at the Bipartisan Policy Center. One of the ideas we came out links to an earlier comment about FSOC and part of the conversation earlier in the debate. Give FSOC the authority to promulgate a rule if an agency doesn't do it misses a congressional deadline by 60 days. Let the Jedi Council fulfill the mission if one of the Jedi Knights fails. I don't think the council will necessarily be able to do it, but man, would that light a fire under the agency to get something done, because the agencies guard turf pretty zealously in this town. It's an idea. It strengthens the FSOC and deals with this lack of tools problem, and it addresses what I think, Meg, you said spot on, and Charles, what you point out, that one of the downsides of independence is the ability to ignore requirements in the law.
Yeah, just on that point, let's just note for the record that 10 years after Dodd-Frank was enacted, it's still not implemented, right? You still have incentive comp in the waiting.
And updates to 23A. But I'm not sure, look, I want to go back to something Aaron said, because there are there's some parts of the law which are unenforceable, right? And the courts the original sin here is that the courts will not enforce the deadlines for regulatory agencies. There's a bunch of court cases from the 90s where folks tried to get agencies get a writ of mandamus, and they all failed. So if the courts would enforce those deadlines, you'd get something more there, right? Aaron's point about institutional structures, right? Institutions writ broadly in the Douglas North kind of sense are more than the words that are on paper. But Congress can choose to be inconsistent because they're the lawmaker, right? So they changed the rules on the exchange stabilization fund and money market funds. In my mind, that goes to Aaron, what you were saying about Congress kind of having its cake and eating it too. But for me, that's not a violation of law. Congress can change the law.
So you're right about that. My point was, I know because I helped draft this section of TARP that precluded the use of the ESF for domestic money market mutual funds, because I'd seen people trying to claw back the ESF for all sorts of good social purposes on the left and other budgetary purposes on the right. When Treasury acted, it was before they changed the law in the CARES Act. I think Austin's analysis was spot on. Do it now and try later. And I have to say, when I was in Congress, I got very upset about this because law is the only power, as Charles points out, Congress has. But in the, when the ambulance or the fire department blows through the speed trap, to fight the fire, there's some push it and pull back. What I think we found is the Dodd-Frank structure really worked pretty well in giving the bank regulators the tools to handle this authority. And if anything, Congress went more towards the bank regulation in the banking system to fix this recession, which had little to do with the banking system.
Right. So your point is we would have been better off being like the Europeans, instead of doing a PPP program and doing it through the banks, just make direct grants to small businesses, right? And in Switzerland, it was a 24-hour and you had your money. Yeah.
I was going to say it's changing the folks a little bit, but if you take a step back from some of the specifics of Dodd-Frank, two of the big themes of the re-regulation of the financial sector and of Dodd-Frank, one of those themes was making the Fed more of the centerpiece of oversight of big systemic institutions to try to forego them developing this systemic crises. And the second was the financial institutions need a lot more capital and force them to hold more capital, raise capital, et cetera. Both of those lessons of Dodd-Frank have proved quite important. Many of the things that we're talking about now are precisely because there has not been a financial crisis associated with this recession. And I think you could argue that at least a couple of the main reasons there has not been a financial crisis have been that the banks and financial institutions have a lot more capital than they had in 2008, and that the Fed moved quickly and has a central position, and because of stress testing and because of others, they can have an influence in a way that they either were reluctant to have or felt they were not able to play in the run-up to the financial crisis. So if you take a step back, Dodd-Frank got two really big things right, have been proven right, so that, at least thus far in the crisis.
Agreed.
So I also want to jump in because I feel like one of the themes that you guys have been talking about is this idea that Congress only has so much power to rein in what the Fed's doing, what the regulators are doing. So how much of the downsides of what's been done are really just Congress is limited? Like it's not necessarily a flaw with Dodd-Frank itself, right? It's basically just, so for example, one of the themes earlier in the event has been personnel as policy. And Charles, you mentioned the Office of Financial Research, where, that's basically disappeared in this crisis. And, there's also some argument about, FSOC not having nearly as much power. A lot of people think that the CFPB has been defanged as well. So, I mean, how much of this is just, you all think that Dodd-Frank was a good law, and there's just, it's not necessarily going to be enforced exactly how Congress envisioned, and how much of it is, Congress didn't do a good enough job writing the law in a way that was sort of more ironclad for, these agencies to be doing things.
Right, I'm going to have to bust out an Army analogy here. So in the Army, they taught us that you can build the best bunker ever, but if you don't man it and if you don't defend it, it's useless, right? So Congress built us a really nice bunker, but in the Army, they tell you need observation and you need covering fire, right? In civilian terms, we're not busy dealing with applying kinetic energy to each other. That means you have to be vigilant in monitoring the financial system, and then you have to have people manning the bunkers who are willing to use the tools that were given to them by Congress. So I think Dodd-Frank built us a nice architecture for dealing with crisis going forward, but then you also need the people to implement the law and use the tools they have.
Yeah, well, and for the 13.3 authority too, it really strikes me because you guys have been talking about how Congress changed its mind essentially on money market mutual funds, and I feel like there's a theme of that too in terms of what you all were talking about, of Congress kind of handing the reins over to the Fed and saying, look, you deal with it. And so, I mean, how much of this is also just inevitable, right? Where, there are always going to be incentives for Congress to hand things over to the Fed to bail out money market mutual funds, and how much of this can actually be solved long-term. Aaron, you're shaking your head, so I'll go to you.
It is, we had a lot of recessions before the great financial crisis. Most of them were caused at one level or another by a combination of extraneous shocks plus Federal Reserve interest rate tightening, right? And the last recession, the financial crisis, was caused by horrific financial regulation plus blah, 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 right? And it wasn't a monetary policy situation. And ultimately, the Fed used a series of 13.3 authorities. The first time we tried to rescue the system through this unusual financial situation. This crisis was not this recession had nothing to do with the financial system as its root cause, right? It was a real virus that infected the real economy that then had a ramification in the financial markets. That's the exact opposite of the last crisis. That was an infection of the financial markets that infected the real economy. In my opinion, a better functioning Congress would have done these authorities and cut a deal. Look, in 2007 and 8 in the recession, we sent direct checks to people. We negotiated the Treasury Department, not the central bank, as the one who would inject hundreds of billions of dollars of capital into the banking system, right? That was a Democratic Congress and a Republican president in an election year. But now we've reached a structure or a problem where everybody's turning to the Fed. And we can debate, why is that? Is it that Congress can't reach an agreement? Is it a lack of trust of this administration? Does it have to deal with, ironically, the transparency issues Meg pointed out? By law, the Fed is being more transparent than the Treasury Department as it relates to PPP and SBA, right? I'm old enough to remember when transparency at the Fed was a giant goal. And now it's the Treasury Department, other aspects of this administration. But I am concerned that this is a structural change where the Congress is going to give up its more effective and important tool of direct monetary policy and try and solve fundamental economic problems through financial means, which I think is both less efficient and deeply inequitable in terms of the results.
I do want to talk a little bit about OFR too, specifically, which is, do you all think that the issue is just personnel, or do you think that the way that it was designed in Dodd-Frank sort of doomed it to not really have much power and not really work?
I'll start there with the unpopular position. I don't think it's personnel. I think it was flawed in its inception. It was a last-minute ad, and it was, it was an idea. It was kind of a great idea of some academics about, let's just in the same way we get all weather movements, let's get the movements of all of the, transaction flows of all financial transactions. But until we get artificial intelligence, none of that's possible. So I think having seen that the original conception didn't work, they tried to do something else. And you've already got all of the agencies basically doing research. So I call it good idea, badly flawed, and we don't have the kind of the technology to do what it wanted to do. So I think it should, I just don't think it's doing anything and that it will do anything.
Yeah,
I expect that's an unpopular viewpoint in this group, so you guys can jump in and disagree.
Not just having lived it, OFR is just a result of the death by 1,000 cuts during the legislative process, right? Because OFR was one of the efforts at what we're talking about with the Fed actually getting more powers in Dodd-Frank. When we went into the legislative process, there was a lot of desire to sort of even out the distribution of power among the different agencies as opposed to one agency just having a monopoly. And OFR was designed to be a counterbalance to the Fed. And it was initially designed to be outside of Treasury. But of course, Treasury and the Fed were one and the same in some respects. So there was a great deal of resistance. So during the legislative process, OFR got gutted and neutered and got put inside Treasury, where Treasury could just keep its thumb on it and keep it from being a competing power center to the Federal Reserve. So that's really the reality you see today. And that's just an example of what I'm saying, is that Congress can write whatever law it wants, but if you don't have buy-in and consensus from the people who have to carry out the law, that's the results you're going to get.
In a way, that one's got that one cuts both ways, because you can undermine a law that's written through personnel decisions or by just not enforcing it, or you could undermine the law as it's getting written. And there was one conception that the OFR would be an independent power base, that they could subpoena the data, that if the OFR called you up, the CEO would be like, oh my God, the OFR called, get this stuff and send it to them so we don't get in trouble. That was already, by the time Dodd-Frank passed, that was already changed. It was piped through Treasury. So it was, yes, we could have a more robust leadership at OFR. They could embrace a bigger mandate than what they have. But I kind of think that long ago, that one was already out of the barn.
So let me just add that we have a problem in structuring all these agencies, right? One theme of every financial crisis is you add a new agency, right? Dodd-Frank added 2.5, OFR, CFPB. We'll debate if the FSOC counts. So but we didn't create them as standalone. The CFPB exists inside the Federal Reserve System, right? OFR exists inside Treasury, right? This isn't unique. I mean, the OFR thing, the OCC exists inside Treasury, but the OCC acts more independently than the OFR within Treasury, right? And that's a choice of leadership. And so I think there's a little bit of truth on both sides here. The OFR director chose to serve more as a staffer to the FSOC, right? Part of this is the law was unclear. Are they the staff to the FSOC? Are they the principal? Are they informing it, right? And when an OFR person chooses to submit their analysis to Treasury and to the other agencies of FSOC for comment, then they're foregoing their own statutory independence. They're gaining something else. And that was a choice made by the OFR. If the OFR played its cards leaning more towards independence, it could have lost other things. But But, one of the core problems we have is we're not creating new standalone agencies. Every new standalone agency, when you actually look carefully, was placed inside something else.
Well, maybe we have too many agencies, right?
If I could just mention one thing about Dodd-Frank that I wish could have been stronger, in addition to what foreign a few other things, is OMWI. I don't think it's been mentioned today at this conference, but the Office of Minority and Women Inclusion. It was part of the legislative compromise, and I think it took a lot of effort just to get it in Dodd-Frank. The entire bill was on a knife's edge, and it's just getting to 60 votes is tough. But if you look at the OMWI provision that went into HERA, that governs the GSEs and the home loan banks, and then you compare that to the legislative compromise that went into Dodd-Frank, you'll see that there was a lot more that could have been done. And that's really one of the issues that I wish that we could have been stronger on in Dodd-Frank.
Meg, which agency did you get rid of?
Yeah, we've got 100 years. The Volcker Alliance has a really good study up in PowerPoint. We've got 100 years of trying to, rationalize the boxes of our regulatory agencies. We've got 3 federal bank regulatory agencies, but we've got 100 years of failure in trying to, combine those boxes. So that's probably too big a one to take on. But I wanted to pick up on something that Charles and Aaron were saying this, because there's a limit to Dodd-Frank and its framework, right? The framework has worked really well in many things. We've got a bunch of stuff on the agenda now that wasn't on the agenda at the time of Dodd-Frank. Cybersecurity, what people call innovation, but I think really means, fintech, particularly payments, digital currencies, central bank digital currencies, and the Dodd-Frank framework, because Dodd-Frank's really just a blueprint, has nothing to say there, right? And so we have choices to make about whether financial regulation is going to be, whether payments companies are going to be regulated at a state level or a federal level. And I'm not sure, Aaron, that's a new agency, but that's kind of where the future is. And if we think about things like financial inclusion, right, because there's a limit to what financial regulation can do in terms of solving the really tough social and moral issues we have at the moment. But if you think about financial inclusion, payments and digital currency are, that's part of the architecture. I'm trying to build a new house, not keep burning down houses. And maybe it's a bunker I'm trying to build, Charles.
Is it that Dodd-Frank doesn't have anything to say on Dodd-Frank or on financial innovation, or that it's actively potentially going to hold back financial innovation because it's outdated?
I think it's just silent because it wasn't on what we're calling innovation now. I think it's silent. Aaron, I know you wanted to say something.
I just wanted to say, the payments perspective is exactly illustrates the earlier point we made. The Federal Reserve by law is required to update the availability of funds, the Expedited Funds Availability Act, to let people have their money as quickly as possible. And the Fed has willfully failed to do this for decades, in large part because its competitors have built a better system than it, and it doesn't want to lose market share as an operator, so it's not fulfilling its legal regulatory requirement. What's the upshot of this? The stimulus checks went to people, the funds, through the Federal Reserve on Good Friday, and they didn't get access to their money until the following Wednesday. Billions of dollars were lost in overdrafts, check cashing, late fees, the financial stress. I mean, what's the statistic? 1 out of 6 mothers have problems putting food on the table, and yet your money's sitting in a financial netherworld for 5 days. These are treasury funds. We don't need a new regulator. We don't need a new Federal Reserve payment system. This is a problem of regulatory will and we don't need a central bank digital currency. All you needed was a regulator who had the will and authority to say, why should millions of Americans in the midst of a pandemic suffer 5 days for their treasury funds to be made available, while the banks I regulate make billions in overdraft fees? And the Federal Reserve wasn't up to that task, even though the law requires them to update these funds availability acts, time schedules, which they haven't done.
So on fintech and Dodd-Frank, I have to agree with Meg that Dodd-Frank was not contemplating financial innovation in the industry. I was there. That we were busy trying to deal with the financial crisis and how to strengthen the financial system. I will say, though, I think one aspect of Dodd-Frank that I think some fintech companies have found helpful, probably not everybody, But the fact that a lot of fintechs intersect with consumer lending, consumer laws, and I've talked to a few companies that have had this experience, but now that Dodd-Frank has consolidated the administration and oversight of all the consumer laws into one agency, namely the CFPB. And I know that earlier today in the conference, there was some discussion and debate about the CFPB, but I think the fact that there's one single point of contact for a lot of these consumer-facing fintechs to go to, I think it's a byproduct of Dodd-Frank. Was not part of intended design, but a lot of fintechs I have talked to have found that to be helpful.
You know, I think that if you take fintech or the development of some other financial developments that were not on our radar screen when writing Dodd-Frank, the one thing I will say is that with the FSOC or the OFR, or there are a series of institutions which, if somebody wanted to, you could envision, if they viewed the development of some alternative payment system as being a systemic threat to the system, that they could take either regulate it, or the Fed could oversee it, or the FSOC could identify, here is the systemic threat that we've identified in the system. And that's at least healthy. That kind of did not really exist before Dodd-Frank. So with the invention of fintech in a world before Dodd-Frank, there would literally be nothing that anybody could say about it. Now we still have the problem. If the administrators don't want to get involved, it will be hard to get the horse to drink, even if you got it to water. But I do feel like Dodd-Frank at least gives you some tools to identify things on the horizon, even if we didn't have them in mind when we wrote the law.
I mean, Austin's spot on. If you look at the data requirements that the Bureau has, right? These are a huge question about this, the value of the rights of your data and who has access to it and who can permission it. This is a huge and consequential decision for fintechs. And Dodd-Frank creates the framework. Now the Bureau has to make a tough choice. And it's hard to regulate people making tough choices. Somebody's going to be unhappy. You got fintechs and innovation, you got banks, you got consumers, you got a big problem and an issue. When Director Cordray was on earlier, was making some progress on this. Where's the Bureau on this? I mean, right, the structure is in place. I think Dodd-Frank was remarkably resilient to these new innovations that were not on people's minds, as Charles points out. But all the law can do is create the structure. The regulators have to make the tough choices.
So I'm going to jump in here because there's an audience question that I wanted to pose to you guys. Meg, I think I'll start with you. They're curious what you all make of the new interpretation of the Volcker Rule and how that might impact systemic risk.
Well, I think I agree with the earlier panelist. Can't remember his name, is the fellow from MIT. The changes to the Volcker Rule are really, they're on both the prop side and on the fund side. They're really a slight recalibration based on lessons learned, right? Statute hasn't changed. There's been some loosening of some elements based on kind of almost 10 years of experience. And I think at the end of the day, the prop ones have been in for several months now. I don't think we've seen anything major happening there one way or another. It's still market making underwriting. I think on the fund side, some of the changes that went in last week, particularly permitting venture capital funds, which had been raised on the congressional floor the Thursday before it passed, will be helpful in an economy that is trying to to have investment and to move its way out. So I see them as minor technical changes that move the needle just a little bit. I think, coming in as a policy matter, I think there's many much more important things for folks to be looking at.
I'll take a step back and kind of observe that we're still in the implementation cycle of Dodd-Frank 10 years after the fact, unfortunately. We've observed that there are still regs that need to be done, and I think we're in sort of the oscillation cycle of this. You take CFPB for an example, right? Depending on what happens in November, I think all the enforcement activity and regulatory activity at CFPB will snap right back. And I feel like Volcker is another one of those. I suspect, I don't know, but I suspect the next the Democratic administration will probably snap some of these things back or scale back what was just done. So we're still in this up and down cycle. And I think over time, I'm hoping to see kind of a stabilization of the oscillation, because it's not healthy for the financial system or the republic to have that back and forth constantly.
So I agree with you, Charles, and that's one of the things that concerns me about the Supreme Court's decision yesterday, which fundamentally makes that oscillation the kind of new norm for the Bureau and probably the FHFA, right? I mean, the logic about this kind of invented right-wing judicial logic that a single agency head is somehow different than, they don't call it a bipartisan commission in the justice's ruling, they call it a balanced commission. I don't even know what that word means that Justice Roberts did. It kind of invented as part of this strange rationale, but that's exactly what the Supreme Court is heading us down this road, which I share your concerns about the kind of long-term economic and the incentives to develop a system that innovates in regulatory box A, but then when party B's in power, it fails. But then if you hold on long enough, and you're going to have these banks and other innovators literally build up two compliance regimes, right? The Democratic compliance regime and the Republican compliance regime, which makes no sense. But I do fear the court pushed us further down that road by weakening regulatory independence in both housing finance and consumer regulation.
I see what you're saying there, Aaron. I guess there's some evidence going both ways. I was very close friends and my personal hero, Paul Volcker, was really my hero, and I worked with him at the time of Dodd-Frank. And at one point I asked him about, it wasn't called the Volcker rule, that came later. I asked him about this proprietary trading and the argument, couldn't this just be left to the regulators, that if they think it's important, then they have the authority? And his view was, there is something important about writing it down, that even if it was not to be enforced, if it was on the books, we want commercial banks not to be doing proprietary trading for their own accounts with subsidized money because they have access to the discount window. If that wasn't explicitly written down, there would be massive lobbying pressure on the head of the Fed or on whoever was making the decision. Oh, we're safe, or leave us alone, and not do it. And so to the extent that they're going to argue about the granular details of, should this be included, should treasuries be included, how should venture capital be treated, et cetera, that's fine. That's healthy. They should sort that out. On the basic idea that about the philosophy, should you be able to get subsidized money and then invest that money for your own account, I do think there's a benefit for that to be written down. The other side that I think is relatively unhealthy is if we write down the idea of systemically significant financial institutions and that the Fed should be their regulator, and then you have those institutions suing to say, no, you can't declare us to be systemically significant. I feel like that's a really serious threat to the whole enterprise, because that's one of the central nuggets of the idea, is that there are not traditional circa 1934 style financial institutions, and they need to have a regulator, and that regulator should be the Fed, and they could apply a SIFI charge or whatever. If you are able to use the court system to get out of that, I kind of think that really goes at the heart of the law.
So we're almost out of time here. So let's do a lightning round of something that you think is one of the big things that Dodd-Frank didn't address that does need to soon be addressed. So I'll start with Austin.
I guess I would say the GSEs. I mean, that was they were obviously central to the financial crisis. They're super important. And I don't know if Dodd-Frank might not have been the right venue. It was hard enough to pass it as it was. So I could see what you wouldn't reform GSEs at the same time, but that's probably the most obvious one.
Aaron?
Payments. They are a giant reverse Robin Hood, which our decrepit payment system sucks tens of $billions a year out of families, the half of Americans who live paycheck to paycheck. It is exacerbated in this COVID recession. It is a simple regulatory and technological fix, and the inability of our legislative and regulatory system to get this one right deeply concerns me. At the same time, we all talk about the serious problems of income inequality. Here's a very simple fix. The Federal Reserve could do it tomorrow. There's legislation by Senator Van Hollen in the Senate. It could be passed with no budgetary impact and put billions of dollars in the hands of folks and put a real dent in overdraft and payday lending demand. That to me is the single biggest problem that we could solve easily and have a giant impact today.
What about you, Meg?
I actually strongly agree with Aaron. Payments, getting payments right, modernizing payments, and getting it regulated. I think actually there probably needs to be legislation, and we need some kind of payments federal charter, and we need real attention on that regulation and real attention on that charter and getting the payment system right. We're so far behind, and if there's anything that, of the many lessons we've learned from COVID, fixing payments is one.
And Charles, you have the last word.
Oh, thank you. Just on GSEs, I know that during Dodd-Frank, we were criticized for not including GSE reform, and 10 years afterwards, we still don't have it. And I know how difficult it is, both substantively but politically, to do GSE reform. When I worked for Chairman Tim Johnson of the Senate Banking Committee, we spent at least a year and a half to 2 years of our lives working every weekend trying to get that done, and we ultimately could not. So to say that we should have done with Dodd-Frank when we barely had 60 votes for Dodd-Frank, and often we were down to 59 and had to scrape together 60 votes to get that passed, I think trying to do GSE reform would have meant that Dodd-Frank never got done. So I'll end with just 2 words: CCP resolution.
Oh, you threw in a curveball there. Okay, so we got payments, Fannie and Freddie, Central County parties. Okay. Well, thanks everybody. I feel like we could have done another hour of that. That was fascinating. We're going to take a short break before the final panel.
Thanks for watching. Be sure to like and subscribe for more videos from Brookings.